Welcome back, everyone. On this episode of the Joseph Carlson Show, Apple is winding down its electric car effort after it had spent over a decade trying to build an electric car. We're going to go through all the details. Why did they wind down this effort? Why did they try building a car in the first place? What does this mean for the future of Apple? What does it mean for the future of Tesla? I'll be breaking down this news as a long-term investor in Apple. We're also going to be looking at some of the pundits. We have Gene Munster here that went on to CNBC and gave his opinion of why this is bad for Apple, how he was disappointed and somewhat shocked by the news. And we're even going to be looking at the take of a Tesla investor. We have Ross Gerber here explaining that Apple never could compete with Tesla. We'll be breaking down his arguments as well. Now, of course, we have some other news. The Google CEO, Sundar Pichai, was finally forced into making a public statement about the massive blunder that was the release of Gemini. He called it unacceptable, and he's apologizing over the release of it. We'll be looking at his full statement. Now, we've also had some controversy coming out of the fast food industry. There's a lot of news and buzz, in fact, it was completely viral, that Wendy's was going to implement surge pricing, similar to Uber, where during peak hours, their meals would get more expensive. Now, this, of course, made a lot of people upset. A lot of people were shocked by it. And Wendy's has since come out and clarified that they have no plans for dynamic pricing. We're going to look into this news, see what Wendy's actually said, and see how they could implement something like surge pricing without upsetting people. And then finally, we're going to be looking at my portfolio. I have the passive income portfolio. I've been showing this transparently since 2019. And I'll be showing you again how things are doing. I'll show you how every single holding is performing year to date, which ones are outperforming and which ones are underperforming. So we have a lot to get to in this episode. If you like this type of content, make sure to subscribe to the channel and ring the bell notification. Now let's first start off with the breaking news of the week. We have a report that was broke by Bloomberg. They're the first one to report on this, saying that Apple's winding down their electric car effort after a decade-long odyssey. Apple is canceling, so they're not just winding this down or putting it on the back burners, they're outright canceling their decade-long effort to build an electric car. The two executives told staffers that the project will be winding down and that many of the employees on the car team, known as the Special Projects Group, will instead be shifted to the Artificial Intelligence Division. Those employees will focus on generative AI projects, an increasingly key priority of the company. So Apple's shifting people from the car project to AI. Now there's different takeaways from this news, a lot of different perspectives. In general, Apple shareholders didn't seem to be too concerned by the canceling of the Apple car. The stock was up 1% after the release of the news. But Elon Musk celebrated the move. He shared a post on X social media site with a saluting emoji and a cigarette. So this is one of those weird situations where both some Apple shareholders and Tesla seem to be happy about this move. Now, my portfolio, Apple has maintained one of the key positions, and it's been a tech company that I've held for one of the longest periods of time. Apple's a big winner of mine. I started buying the company in 2018. I added more to it in 2020. The company's about a 9% holding in my portfolio. Currently $52,000 of total value and $23,000 in gains. So I've been in Apple for a long period of time, and I've been very resistant to sell any of my shares in this company. And don't be mistaken, this news was a bit of a shock. Bloomberg says that the decision to ultimately wind down the project is a bombshell for the company, ending a multi-billion-dollar effort called Project Titan that would have vaulted Apple into a whole new industry. The tech giant started working on the car around 2014, setting its sights on fully autonomous electric vehicles with limousine-like interior and voice-guided navigation. Now, I could go through the entire history of the Apple car, but to summarize it, in 2014, they started the project. They hired many different executives from different leadership positions from different car companies, and then they tried to hide their efforts by having different offices, anonymous logins, and lots of efforts to keep other people from figuring out what they were doing. But ultimately, they had a high amount of turnover in their executive roles. They had delayed timelines over and over again, and they faced other challenges that made the Apple car seem like a less worthwhile bet. Bloomberg notes that in the end, Apple is facing a cooling market for EVs. Sales growth lost steam in recent months after high prices and lack of charging infrastructure. This may have discouraged mainstream buyers from shifting to all-electric vehicles. So even Tesla's seeing a slowdown in their sales growth year over year. Tesla themselves has noted, they warned in their recent earnings reports, that sales expansion will be notably lower this year. Domestic EV sales growth will decelerate to 11%, from a year ago where it was an estimated 47%. So sales growth in EVs is slowing down dramatically at a time period where Apple's trying to figure this out and putting billions of dollars into this effort. And ultimately, they decided it was time to just shift gears, move away from the car into AI. Now let's go ahead and take a look at whether or not this is the right decision. We can first look at some Apple analysts. We have Gene Munster, who went on to CNBC, and he gave his thoughts of whether or not he thought this was a good idea in the first place.
Well, I think Apple thought it was a good idea, and I think that they've got a history of redefining, reimagining product categories that were getting off the ground. And so the amount that they're investing by my measure was about $1 billion per year, most of that coming over the past 3 or 4 years. And Tim Cook said famously in 2017 that autonomous vehicles are the mother of all AI projects. And so if you listened and watched what they're doing, they wanted to do this. This was a goal. And of course, they've now shifted direction. So that's what surprised me. I had put the odds at this at 50-50 that this would come out, 50% chance. I'm famously wrong for predicting Apple Television that got killed in 2017.
He says this is something Apple themselves wanted to do, which of course they put in a lot of effort into this project. He also goes on to explain that shareholders should be disappointed by this news.
I think they should be disappointed. And part of it is that Apple's a tech company, and tech companies by definition need to grow. And that's the $400 billion question that they have. That's their revenue this year. And to grow a top line, they haven't grown their top line for the last 6 quarters. And to grow the business, you got to get into some big markets. Vision Pro has some potential, but was the kind of the shiny opportunity related to the car. This could, if they get 10% of the automotive market, that would grow their top line by 60%. We can set aside the earnings question. But I understand that most investors thought that this was a low probability, and that is reflected in how the stock traded today. But ultimately, I'm disappointed.
He's disappointed because tech companies like Apple ultimately need to grow, and this would have added a lot to the top line of Apple. I don't agree with Gene Munster here, and I think that ultimately Apple investors shouldn't be too disappointed by this move. There's a couple reasons for that. For every company I invest in, top line growth is an important thing I look for. Organic top line growth is important for a stock, and I agree with Gene Munster that an Apple car would certainly grow the top line. But top line growth is only one part of the equation. Apple likes to grow the top line in a profitable manner. They're able to accomplish this high amount of profitability because of the high margins across their various products. For example, if we go into the operating margins, we look at the past 10 years of the company, we can see the current operating margins are around 30%, 29.8% to be exact. We look at this in previous years, 30%, 29%. In 2020, it went down to 24%. And overall, it's well above 26% into the 30% range. One of the key questions that Apple needs to ask themselves whenever they go into a new product or a new category is, will this hurt their profit margin? Will it raise their profit margin? Or will it be profit margin neutral? And we can look at the example of EVs. The undisputed leader in EVs is Tesla. They have the dominant market share, they have the charging infrastructure, they have everything going their way currently. And we can compare Tesla's margins against Apple's. For example, we'll pull up Tesla's operating margins. The highest operating margins Tesla has ever had in its history was in 2022. The stars aligned that year. There was huge growth in China. There was low interest rates. People could get low financing. Tesla could price their cars very expensive. It was everything working for Tesla. And the operating margins were 16.76%. So at the height of Tesla's margins, the highest year ever, it was roughly 50% of Apple's current margins. That is their best year against the last 3 years of Apple. In 2023, Tesla's margins dropped to 9%, which is roughly a third of Apple's. So unless Tesla can 3x their operating margins, it looks like Apple's current business is much higher margin than Tesla's. Now, maybe that will change in the future. Tesla's working on increasing their operating margins, but as of right now, Apple currently has a much more profitable business than Tesla. The issue is with Apple is if you currently have 30% operating margins, and then you get into a new business that's currently 9 to 10%, your operating margins are going to go down as you grow revenue. And that's not a great story for investors. If you have a continual story of operating margins going down, it's not good for the stocks, generally speaking. Most stocks do really well with increasing operating margins, not decreasing. The ideal situation for a company is when they can increase their revenue with increasing margins. This is something that Meta has recently illustrated. Over the past year, Meta increased their revenue dramatically. It was up 24%. And Meta increased their revenue while increasing their operating margins. That is a potent combination. Growing revenue and growing margins at the same time typically means the stock is going to go up. Obviously, Meta has gone up. The stock is up 180% over the trailing year. Netflix is another company that's in that basket of increasing revenue with increasing margins. Over the past 1 year, they increased revenue by 13%, while their operating margins went from 17% to 20%. And Netflix is up 90% over the trailing year as a result. Investors like revenue growth and margin expansion at the same time. What they don't like is revenue growth at the expense of the company's margins. Another issue with Apple pursuing EVs is the capital intensity. EVs are incredibly capital intensive, and as we know, that's another characteristic that's typically unfavorable for stocks. As we know, the companies that I look for, I think that capital light is an attractive attribute. Apple already has a lot of capex intensity through their R&D, so adding on more of that through building out EVs puts them in a more capital-intensive basket. That capex heaviness of the industry adds a layer of complexity and difficulty to Apple that I think a lot of Apple investors are fine not having. Now, I'm invested in Apple, but I think it's also important to get the perspective of a Tesla investor, someone that has studied the company long-term. So we have Ross Gerber here explaining his perspective.
I knew they were never going to do a car, being an early Tesla investor and knowing their mode and knowing where they were at. And I had done many interviews back as far as 2015, talking about Apple taking a stake in Tesla. And when Tesla was in trouble in 2018 and needed money, supposedly there was a conversation between the two that Tim doesn't remember, but that lack of memory probably cost him hundreds of billions of dollars for Apple shareholders.
This conversation of Elon Musk talking to Tim Cook, wanting to sell to Apple, is something that I think is dubious if it ever happened. Elon Musk has provided no evidence of this conversation, and Tim Cook has said he doesn't remember that any such conversation took place. I find it difficult to believe that Tim Cook would not remember a conversation taking place of Elon Musk wanting to sell Tesla to him. I think that's something that would stick out in his memory.
And just the same, we see a similar opportunity for Apple if they want to be in this business by taking a stake in Rivian. But they don't want to be in this business, and they've made a clear commitment to Vision Pro, and moving this team over to AI is the smartest thing they can do. So this is a good move for Apple.
Ross Gerber believes that Tesla had too wide of a moat to be competed against, and that Apple doesn't want to get into this business at all, which is the right move. And I actually agree with him more than I agree with Gene Munster. I think that he is correct on his analysis of this. Tesla does have a very wide moat in EVs already, which would be incredibly expensive for Apple to compete against. Now, Apple could go head-to-head against Tesla. They could use their massive amount of cash to just build out infrastructure, spend a ton on capex, and compete fiercely with Tesla. But what are the profits in doing that? If Apple goes head-to-head in Tesla, competing with them in everything they're doing, building out infrastructure, pricing their vehicles cheaper, making new models all the time, where are the profits in doing so? That seems like such a low return on capital effort by Apple. I don't think Apple's in the business of competing just for the sake of competing. They want to make money. They want a high return on their capital. Instead of competing with a insulated market leader in a highly competitive industry that's capital intensive and lower margins, Apple is moving on to compete with a different company. Apple's competing in the game of AI. Artificial intelligence stocks have gone on an incredible run. Microsoft is up huge because of their run with artificial intelligence. When ChatGPT was released, that took the stock to a whole new level, bringing it up 65% in the trailing year. Now, some may say that Apple's behind in AI, but Apple does maintain an enormous opportunity here. They have well over 2.2 billion installed devices. This is an enormous opportunity for Apple to wrap AI into their entire ecosystem, strengthening the thing that makes them the most money. Their ecosystem is key, and if they wrap AI into all of it, making every single application better and more unique, with all of the extensive data that they know about you as a customer, they could make the best AI assistant in the market. So while on a surface level this may be disappointing to Apple shareholders, they're not going to see an Apple car driving around. Overall, when you look at the company, maintaining their focus on high margins and high returns on capital is what creates shareholder value. And going into industries that are already dominated by single players like Tesla, they're highly competitive, they have high capex and low returns on capital, is not the way to create shareholder value. I think this is the right move to make for Apple shareholders, and hopefully it focuses Apple on a huge opportunity, which is interweaving AI into their ecosystem. So I'm okay with the direction Apple's taking. Now moving on, I want to do a quick update of my portfolio and how it's performing this year. We're going to be looking at every individual company and the year-to-date performance. For this, I'm going to be using the watchlist page on Qualtrim. If I go to the watchlist page and select my portfolio, the passive income account, it brings up all the holdings here, and then I have the dip finder. Now, the Dip Finder shows how these companies are performing over different metrics, different technical analysis metrics like the price versus the 200-day simple moving average, and we can see how different companies are performing over the past 200 days. This is a measurement of their momentum. We can see that the best performing one in my portfolio over the past 200 days is Texas Roadhouse. Then we have Costco, Chipotle, Intuit, and MasterCard. Now, something I can do interesting here is I can add in another holding, which is the S&P 500. So I'll add in SPY here, it'll update, and then I can see it compared against the S&P 500. SPY is right here. That's the momentum of SPY, and we have all these companies off to the right doing better over that same time period. These companies off to the left are doing worse. Now, if I filter this by year to date, so go to the year to date here, I can see that the S&P 500 is right here. All the companies on the right have done better year to date. All the companies on the left have done worse. So again, we see Texas Roadhouse is my best performing company year to date. It's up 24% after a huge earnings report for 2023 and incredibly strong guidance. This company is a growth monster. It is growing and it's growing profitably. We also have Chipotle. It's up 18% year to date. This is a company that has repeatedly given very strong earnings reports. I noticed that both of my top positions year to date are food companies, Chipotle and Texas Roadhouse, which does not surprise me. I've made a bet over the last couple of years that food companies are going to do really well. There's a lot of secular trends of eating out more often, cooking less at home. People are busy, they want good food on the go. So I believe all of these companies, Chipotle, Texas Roadhouse, they're going to do really well in the future. Then we have Costco up 15%, MasterCard, Microsoft, Intuit, and Canadian Pacific. All of these companies have outperformed SPY this year so far. Now we get to the slackers on the left side. The worst performing by far is Vici, down roughly 9%. Now, the entire category of REITs is not doing well right now. That is because inflation is coming down slower than expected. And I expect this to continue if inflation remains stubborn. If inflation comes down and the Fed lowers interest rates, then Vici should respond very positively to that. After that, we have Apple down 3%, we have S&P Global down 1.4%, and we have Moody's. So Apple and the two credit rating agencies are another two companies that aren't doing well this year. And I think both of them are related to interest rates. These companies rate bonds, and there's more debt taken out during lower interest rates than higher interest. So these companies, again, will respond positively if interest rates start coming down. But overall, even with these slackers, we're still off to a great start this year. Now, moving on, we have news that the Google CEO, Sundar Pichai, is addressing and apologizing for the botched release of Gemini AI. That is, of course, Google's chatbot, which once it was released, it was revealed that it was highly biased. It was also fictionalizing historical events, swapping races of different people during different time periods. And that, of course, is something that doesn't build trust for Google tools. People using these tools know that there's something else going on, that Google's not showing an unbiased, realistic depiction of history, they're changing historical events. Now, this has been called out all over the place, all over CNBC, all over Twitter. Google has felt a ton of pressure, and finally the CEO is making a response. Now, I want to read his entire response here. Sundar Pichai said, "I want to address the recent issues with the problematic text and image responses in the Gemini app, formerly Bard. I know that some of the responses have offended our users and shown bias. To be clear, that's completely unacceptable, and we got it wrong. Our teams have been working around the clock to address these issues. We're already seeing a substantial improvement on a wide range of prompts. No AI is perfect, especially at the emerging stage of the industry's development, but we know the bar is high for us, and we'll keep at it for however long it takes, and we'll review what happened and make sure we fix it at scale. Our mission to organize the world's information and make it universally accessible and useful is sacrosanct. We've always sought to give users helpful, accurate, and unbiased information in our products. That's why people trust them. This has to be our approach for all of our products, including all of our emerging AI products. We'll be driving a clear set of actions, including structural changes, updated product guidelines, improved launch processes, robust evals and red teaming, and technical recommendations. We are looking across all of this, and we will make the necessary changes. Even as we learn from what went wrong here, we should also build on the products and technical announcements we've made in AI over the last several weeks. That includes some foundational advances in our underlying models, our 1 million long context window breakthrough, and our open model. models, both of which have been well received. We know what it takes to create great products that are used and beloved by billions of people and businesses. And with our infrastructure and research expertise, we have an incredible springboard for the AI wave. Let's focus on what matters most, building helpful products that deserve our users' trust. Out of this statement, the big focus here is trust. That if they search for information, they'll find that information in an unbiased and truthful manner. Now, he says in this that he's making real changes. All of these structural changes, product guidelines, improved launch processes, robust testing and red teaming. Red teaming is like an effort of trying to trick the AI. They're trying to make all of these different changes, but it's really going to be whether or not they make these changes. Because once they release their next model, people are going to test it every way possible and try to reveal inherent biases in what Google's doing. The other thing that I think is the most frustrating about Google having the most bots released with AI is that they're the ones that were slowest to release their product. They came out with it after everyone else. We already have Perplexity. We already have ChatGPT. We already have Copilot. Google is supposed to be slower in their release because they're being more safe, more conservative. They're doing more thorough testing. They're not just rushing out a project without any safeguards. They're the big responsible company that's being slow to release. But even though Google was the slowest to release their product, they released a product that had the most biased and crazy, unbelievable responses to questions out of any of these chat programs. ChatGPT and Copilot have much better answers to basic historical questions. That tells something about Google leadership. They should either be the first one to ship a product, move fast and break things, or they should be slower and they should be more responsible. But being last and still breaking things is not the answer. So as of right now, after this big of a debacle on their initial release, Sundar Pichai is in the hot seat, and he knows it. The pressure's on. He needs to get this next release correct. So I expect big things out of Google. I think that this is a fixable problem. They still can regain trust of people if they show that they can iterate, adapt, and make this thing better. Because the first release of it was not impressive. So as of right now, I'm still bullish on Google. I think this is a fixable problem. Now moving on, we get to the news that Wendy's was apparently experimenting with surge pricing. This blew up, it went all over online, and it even found its way onto different talk shows like Late Night with Seth Meyers.
The fast food chain Wendy's has announced that it'll experiment with a new surge pricing menu next year, so a burger may cost $1 more during the lunch rush and $40 more at 3 a.m. We know you want it. Where else you gonna go?
I don't know who's writing these jokes, but it is true that Wendy's was experimenting with surge pricing. This blew up into a big debacle as well, forcing Wendy's to scramble and clarify their plans for dynamic pricing. Now let's go ahead and take a look at what they originally said and what they're clarifying and saying now. What they originally said was, quote, dynamic pricing can allow Wendy's to be competitive and flexible with pricing, motivate customers to visit, and provide them with food they love at a great value. But they mentioned that keyword, dynamic pricing. Now, investors took that term. They thought it meant that they will change pricing depending on demand. And then the telephone game happened a bit and it turned into surge pricing, which of course surge pricing is where pricing goes up during peak demand hours. Now here they are clarifying, saying, quote, to clarify, Wendy's will not implement surge pricing, which is the practice of raising prices when demand is highest. We didn't use that phrase, nor do we plan to implement that practice. So they're saying they're not doing it anymore. Now, obviously, after being mocked and ridiculed and having this blow up online, they have to backtrack, but I don't actually believe that dynamic pricing is such a problem. I believe the way that they communicated it is the problem. What Wendy's needed to do was explain that their prices are going to remain the same, but they can dynamically lower prices during lower traffic hours of the day. That way, it never seems like you're raising prices or prices are surging, but instead you're doing what a lot of restaurants do. A lot of restaurants have deals on Tuesdays at lunch. They have deals on Wednesdays at lunch or Mondays when there's lower amounts of traffic. Well, Wendy's could do the same. They could say that we have our standard pricing, but we lower prices during different hours to offer different deals during lower traffic hours. Essentially, what these restaurants are doing with special deals during lunch is surge pricing. They're raising prices during dinner hours when there's more traffic and demand. But the way that restaurants phrase it is not that they're raising prices during dinner, it's that they lower them during lunch. So all of this could have been avoided by simple phrasing. If Wendy's came out during an investor relation call and said that we're enabling lower prices during lower traffic hours nobody would have made a fuss about that. Now that's going to be it for today's show. If you like this type of content and want to see more of it, you can check out the Patreon membership. We have hours and hours of more new content every single week. And the Patreon also includes full membership to Qualtrim.com, which is the analysis website I built and use. That's all for this time. Hope you enjoyed. See you in the next one.